Hey everybody, TGIM, and welcome to week 34. Great to be back after 2 Monday hiatus from Macro Monday. Sometimes just good to get off the desk, and obviously it looks like someone had thrown a bomb across markets from a cross assets kind of perspective. And as one person wrote me, goes, you decided to leave the desk in probably the most important week in kind of global macro. But we'll see what we can kind of cover and kind of gather from that. As I said a little bit earlier, we are also joined by my colleague Forrest Mao, who covered the Greater China, Hong Kong piece, representing kind of the GST team. Always, everything discussed here solely views and opinions. These not trading nor investment recommendations. So again, super quick rehash from last week. Geopolitics and sentiment, I think, is generally state of disarray. If it's not getting worse, it's definitely improving. Growth and trade wars continue to hang on the market, and of course, since our previous Macro Monday, which is 3 weeks back, we've of course seen some stellar key technical breaks, both from the perspective of DXY, breaking through 97, we're now at 98, and that was again on a second kind of weekly close, I believe. We've seen the yen get to as close as, I think, 105.20, 105 kind of 30-ish levels. Euro dollar kind of has still stayed around the same levels, but generally it's been really a case of USD kind of strength. And then, of course, big further moves upwards on the likes of gold and silver. And again, second kind of very strong consecutive kind of weeks. And I guess the main thing you could say in FX land is really that dollar CNH getting above kind of that 7 level, which is quite key, and I'm sure there'll be kind of questions around that. There definitely was from the Friday kind of lunch as a whole. So not too surprising that maybe it was risk off on equities. This was kind of the moves last week, but I will show you that note the outperformance on China mainland indexes, so to speak, which is I think quite interesting to kind of note, as well as, let's say, places like the Nifty in India, which has kind of been lagging some of the moves that we've seen over the last few weeks from an EM kind of basis, right? And I think for the rest of the commodities was mixed. And then, of course, vol, despite the big kind of pullback on Friday, had a massive kind of move up higher. At one point last week, I think we were up 70% on a month basis on VIX, and we're still pretty elevated, but just a touch south of kind of the 20 handle. And the high we saw last week was about 24.10. All right. Moving on, we're just going to do a quick overview on the COT profile from Ole. Surprisingly, you'd expect maybe a much bigger net long USD exposure with this kind of 98 levels on DXY, but we're actually not there. That's interesting. So we're still around this 12.4. I think from 3 weeks back, we're still around that kind of 11-ish billion net long in kind of the USD. So that's interesting. I think on the commodity side, it's a little bit more interesting from the perspective of, at least here you can see a lot more kind of dramatic moves. So we actually have half of the exposure where commodities were from a hedge fund kind of positioning basis from 3 weeks back. So that definitely is showing you maybe the stronger dollar is a bit having an effect on exposure here on kind of a USD kind of side. Week ahead, again, it's really all going to be focused around the Jackson Hole Symposium. For those of you that don't know, from a global macro geopolitical central bank watching perspective, this is for many the holy kind of grail. It's much bigger than kind of Davos. It is, I guess you could say, the Davos for the central bankers. There have been a few instances, one specifically with Bernanke, and I believe also one with Yellen, where some kind of key policy was kind of dictated. I am sure the press analysts may be extrapolating in regards to maybe this time around, and where Powell will obviously be speaking. All the hoo-has from the central banks around the world tend to gravitate towards this. It's a 3-day event, Friday, Saturday, Sunday. I, in fact, only, funnily enough, at least on Bloomberg, only found one speaker, which was RBA's Lowe, who's going to be speaking there. But everyone basically should be there from the kind of central banking kind of world. What I am kind of curious is from the Fed, they're basically running into two problems, I believe. They've now cut twice. We have actually not seen the curve steepen. We've seen it continue to flatten. We've seen now the inversion move from, what was 3 months, 10 years to now the 2s and the 5s, when we'll see some charts on that. But we've, of course, also seen a stronger U.S. dollar. And the Fed are now painted themselves kind of in a corner where they were not paying enough attention to basically the potential demand for treasuries, given the fact that despite U.S. yields being higher than kind of the rest of the world, when from an FX hedge basis, it actually is still not accretive or yield positive for foreign banks, foreigners to kind of be buying U.S. bonds. So this is a problem kind of with a stronger kind of dollar. So Trump has been right all this time along, and it's rare that you get a Fed chair commenting on U.S. dollar strength. I definitely cannot really recall anything coming from Powell, but it'll be interesting to see if he says anything along the lines of maybe the U.S. dollar is too strong, or is causing kind of problems, or is being kind of monitored. This is very, very kind of big and kind of thematic. There's also a lot of thoughts in my circles of whether or not we could maybe need some kind of new Bretton kind of Woods to structurally kind of weaken kind of the U.S. dollar. But there's just so many things moving against it because, the key thing that also has happened over the last 2 weeks is that outperformance on U.S. economic data versus the rest of the world continues. And it's a relative world at the end of the day. And that's important to kind of bear in mind. And we've also seen, faster races to the bottom. 50 basis points by RBNZ definitely would have tripped me over. I never would have thought that was coming through. And just cascade of kind of cuts that is still kind of going through. So even though I do feel that the Fed has a lot more magnitude, not only to cut rates, but also to move on those cuts compared to anybody else in the medium to long run. In the near term, they still don't really have the data that is pushing them kind of that way, and everyone else is actually moving quite a lot faster. We saw Banco de Mexico cut last week, and obviously previous to that week, we saw quite a few others kind of do kind of the same. So this, I think, is something that's keeping them up at night, especially given the fact that they have cut 2 times kind of in a row. We do have a minutes theme this week from RBA to FOMC to ECB, which for some reason no one really seems to pay attention to ECB minutes. But for the Fed, the next meeting, September 19th, we seem to be priced for 100% probability of a cut. I would also entertain the idea of an intra-meeting cut. That is just something to, I think, put on your radar because it is very much different kind of times at the moment, and I think this curve not steepening is a big thing. And on RBA minutes, it could be interesting. Obviously, they did not move at the last meeting, unlike the RBNZ cousins. Currently, we're seeing a 19% probability of a cut for the September 3rd meeting. That ratchets us up to about a 91% for the December 3rd meeting, with that kind of broken up into, I believe, roughly a third for 25 basis points, 40 for 50 basis points, and then a touch more for actually arguing about a 75 basis point cut by the end of the year, so to speak. This week, central bank-wise, we only have Indonesia and Hong Kong, at least from a major basis. I normally don't put Hong Kong, but I think just given everything that's kind of going on right there right now, it's kind of important to kind of keep in mind. From Fed Peaker's perspective, not much apart from Quarles, and then we also will have, and I think this data is wrong, Quarles is actually speaking sooner and earlier, so do watch out for that. But Powell will be obviously speaking at the Jackson Hole Symposium, so that's something to definitely see if there's going to be a hint of potentially some new kind of Fed policy, if QE is back on track, if there's going to be something to kind of target kind of the stronger dollar or not. So, and Quarles here is speaking on the 21st. I'll correct that on the hard copy. Low, I already mentioned. We also do have something for some of you asset allocators, especially on the equity side. We will be getting the second quarter report out from the Norwegian Sovereign Wealth Fund. This tends to be heavily kind of watched, and they do set the bell curve on a lot of things, especially on kind of the sustainability, ESG kind of investing side. So always kind of important, and I think it's over like $1 trillion that they have. So quite impressive how they kind of run it. Economic data-wise, Flash PMI kind of theme, inflation out of the Eurozone, but it's really going to come back to kind of Jackson Hole. As that is. So I just want to cover one more slide or two more slides before passing it over to Forrest, and then we'll go through some charts. This basically was from our Friday lunch. Again, I'm not going to share everything, especially this strictly off the record topic that we did have. Many thanks to obviously my colleagues both on the RMs, GST, and event side. Lasted over 3 hours. Basically almost had to kick people out. But that's kind of what it is. The whole objective here is to have a very open dialogue with different set of people who are fund managers, people who are running family offices, people who are running bank teams, people who are running their own money, and who all are a combination of traders, investors, entrepreneurs, tech backgrounds, law backgrounds, and obviously kind of banking and finance background, engineer background. So it's always very eclectic, and I always come along learning a lot, so to speak. So I think what was interesting in regards, and this was actually a comment from one of my colleagues, actually the very talented Brandon Lee, where he was basically saying kind of the takeaway he was having from a lot of the dialogue he was having maybe with his clients is maybe people are a little bit too bearish at the moment, kind of compared to maybe where we've kind of been before. So that's kind of the feel that he was getting, which I thought was an interesting kind of observation. What's also interesting to note when I was speaking to some of my traders is, yes, we did have that big spike in the VIX, and we've had quite a bit of a pullback, but it's not like there was a lot of people invested with a lot of kind of conviction, which again is kind of another interesting point of view to kind of take into account. Now, I'm obviously talking here kind of, in broader terms. I appreciate HSI is, something like 20-25% kind of off kind of the highs, but obviously that's been a lot more of a localized thing that's been happening kind of there. And the other kind of part that I found interesting was a lot of discussion on the U.S. dollar, and again, still a mixed view in regards to whether it's been too strong and now we're going to see weakness, or it's still going to be strong kind of for a while, more really because, to get a weaker dollar, you need a potentially at least a stronger kind of euro, a stronger kind of China, and a yuan, and we're just not really seeing that at the moment. So that was interesting kind of from a contention point. There was a lot of questions on CNH, and I'll show you that from the chart. And for me, dollar CNH, the question really was, are we going to be getting back below 7, or going to move further back by the end of kind of the year, so i.e. higher? I think it really all comes back to Trump. Like, from my perspective, Trump's strategy is you create your problems, you then point fingers at it, you then go back and you solve the problems, and then you take all the reward from it. And I think he's lining everything up for obviously the election year next year, and that will be solving China, that will be solving Iran, that will be solving anything else kind of in the Middle East, it'll be solving North Korea, so on and so forth. So it's really a timing perspective of when he has to do that, because he kind of has to do that also in a way that the win leads also into kind of economic kind of growth and a boost. So I'm assuming his timeline is probably fourth quarter to latest first quarter next year, right? Is kind of how I'd be going from at least the China perspective, which is probably kind of the biggest. So it's based on that, how dollar CNH and dollar yuan would kind of do. And to be honest, overall, probably dollar strength. If there are some kind of moves to weaken the dollar, as we talked about last time, maybe a facility that sits out of the U.S. kind of Treasury desk, and they put in $500 billion or they put in $1 trillion or whatever it is. Moves like that could also be interesting in causing a little bit more volatility and maybe adding a little bit more kind of downside to kind of the U.S. dollar. I mean, whether or not they can structurally really change things while the rest of the world is moving another way, really, really hard to say, and super kind of doubtful on that. And I think one other thing that I noted is on big kind of opportunities. I was a bit surprised how little appreciation my view of what's going on in the UK was taken up in the room, especially given the fact that obviously in Asia a lot of the money is first generation. A lot of our clients are either that or they've kind of made it kind of themselves. A lot of them tend to understand real estate. And to me, what's happening now in the UK, we've talked about this many, many times, but again, I only bring it up and repeat it many times because I think it's just exceptionally compelling. It's a multi-generational opportunity to own sterling assets, whether that is property, whether that is companies, whether that is equities or bonds. But I think kind of the hard assets are much more interesting. And I was, again, pretty amazed at the fact that no one's really talking about this. I appreciate it's contrarian. I appreciate people are tired. I appreciate it's exhaustive. I appreciate in the near term no one knows how it kind of unfolds. But at the end of the day, there really is only one UK. More importantly, there's only one London. There's only certain institutions there that can't be replicated anyway. You sit in a very particular, unique time zone between the U.S. and Asia, and there's just a talent pool and an expertise there that is just not going to fall off the face of a cliff, right? It's a very, very, very different situation from, let's say, Hong Kong. It's not just about London. A place like Manchester has over 10 million people, and actually a lot of the growth in the real estate has actually been greater outside of London and kind of at lower kind of prices. So that I think was just something to me, which is I think a multi-generation opportunity. So definitely something for some of you with longer term horizons, with potentially a lot more kind of money to kind of work. But that was what I was very much kind of banging the desk about. And then, of course, this strictly off-the-record topic, which we will definitely not touch on this time kind of around. And then lastly, just before I pass it on to Forrest, we were kind of reviewing this big piece. And, of course, as you remember, this was from Macro Monday, where basically I was saying the meta trend is for yields lower. We have been spectacularly correct and right on that in some cases. Not just making lower lows in bond yields and higher highs in bond prices, but sometimes all-time new lows. And that means historically, not just in this kind of cycle. So i.e. the likes of, let's say, bunds in essence, or the likes of, let's say, Australian kind of 10-year bonds. What we still have not yet seen is, of course, that I've gotten wrong so far has been the weakening in kind of the US dollar. I think that's more function of what's happening in kind of the rest of the world versus the U.S., but where we've also continued to be spectacularly correct has been in the multi-year breakout higher in precious metals. And if you recall, I kept telling you how I just kept thinking that silver was a better kind of skew, and that's totally kind of played out. And what's really interesting is silver right now is trading at about $17.12. It's still not above the high of 2018, which was 1770. Meanwhile, gold is at very much kind of multi-year, 7, 8, 9-year kind of highs. So there definitely is still kind of a lag there. High yield is continuing to outperform. Risk parity is still working. So, again, with this, you always have to take a little bit of a grain of salt because a lot of it is kind of when you take kind of the snapshot. I still do think on a longer term perspective, be that 9 to 18 months, lower yields will kind of continue going back to kind of inflate all assets. That will include equities, that will include private equity, that will include VC, that will include real estate, before we just kind of get to kind of a tipping point where you can only blow so much air back kind of into the balloon. But you have to bear in mind that the Fed still has 200 basis points that it can cut. It can still go back into QE. It still has the most unlevered balance sheet compared to, let's say, the ECB, and definitely compared to the BOJ, right, which is sitting at a balance sheet on its books that is more than the GDP of kind of the country, which is buying equities, which is buying bonds. So there is still a lot that can happen on the Fed side. So do I think yields can go lower? Absolutely. I mean, we were talking about bunds going to record new lows when bunds was still positive 20, and bunds are now circa minus 70 basis points, right? So the meta trade is very, very much, and the key meta trade again is yields moving lower, is still very, very much in play. The sub themes off of that, such as precious metals breaking out is happening, high yields outperforming is happening, risk parity still working is happening. Equities, to be honest, very much kind of around the same levels where we were. Funnily enough, when we had the last VIP kind of quarterly kind of lunch, we'd gone on to make new highs. The key question, I think, is really all about kind of the USD, the FX, and of course the inversions we're seeing. And now for just the next two slides, let me please pass over to my colleague Forrest Mao. Thank you.
Hello. Good morning, everyone. This is Forrest from GST in Shanghai. So over the weekend in mainland China, there's one breaking news in financial industry that is widely reported and probably a historical event. That is interest rate reform announced by PBOC. Its aim is to lower the borrowing cost for the private companies. Before we go deeper, let me show you some background for this reform. So currently in China, the funding market is segmented or isolated between the two interbank funding markets and the commercial loan market. The reason for this segmentation is that the interest rate transmission mechanism between these two is not smooth or it's not market driven. So commercial banks, they anchor the loan prime rate to the benchmark lending rate, which is set by the PBOC. As you can see from the chart on the right-hand side, the loan rate benchmarks in green and yellow colors are not moving with SHIBOR, as shown with the white lines. So the consequence is not desirable for the companies and not desirable for the whole economy. As you can see, the weighted average loan rate shown in the red line is not declining much, as with the drop in the interbank market. As you can see, the white line SHIBOR, it has dropped a lot, while the red line is still hovering near the 6%. So comparing to the massive rate cut, I will say this reform could structurally boost credit growth in the private sector. Next slide. Okay. So this slide is just to show you the more details behind this reform, and I've also attached the link to the official statement from PBOC here. Basically, there are four major changes on the LPR mechanism. First is the loan rate quote method. So previously, the LPR is quoted based on the PBOC benchmark lending rate, but now it's quoted based on the open market operation interest rate benchmarks, mainly the 1-year MLF, which is more flexible and market-driven. And previously, the bank consortium has formed the implicit loan rate floor, which is artificially high. The second, the quote frequency, is changed from the daily to monthly to increase the quote quality. And the next new one is going to come out tomorrow, the August 20th. Thirdly, you will add the 5-year or above loan prime rate reference. This is to facilitate banks' longer-term loan pricing, which is good for long-term projects for the company. And fourth, it's going to expand the quoting banks number from the previous 10 banks to the 18 banks. They will include the much smaller banks that are focusing on the small and the medium enterprise. They will also include the foreign banks and the private banks. So this will increase the quote effectiveness. Also, PBOC announced the ways to implement this reform. First, they will include this new LPR execution and competition into the macroprudence assessment, actually the final exam for the Chinese banks. So they will count that. Also, PBOC, they will encourage companies to escalate bank consortium to form the implicit loan rate floor. So overall, this is a background. As for the implication for the markets, I did not put here because it will be quite long term. So overall, I believe it's good for the economy as a whole, right? Because it's generally, in a sense, migrate. I would say I will use the word migrate. It migrate part of the profit in banking sector to the private sector. And I will say in the mid to long term, the banking sector will feel some pressure in terms of the interest rate margin, and the private sector is going to have some support. And this is going to hedge some of the downside economic growth pressure from the outside and the inside. Yeah, that's all for the in the Greater China part. Have a good day.
Fantastic, Forrest. So I think just to reiterate, this is huge. This is a game changer because what in essence is happening is this is where Shibor has been, i.e., with the dovishness that's come from the PBOC and the Chinese kind of policymaker, so to speak. Whereas, if you're on the private side, you've still been stuck over here. So this is huge. Like it doesn't even have to come the whole way to be a game changer. If you don't really follow or know too much about kind of the Chinese economy, all the growth, all the job creation really comes from the private sector. It actually really does not come from the SOEs, if anything. So again, it could be a question of just how quickly this can be kind of be initiated. But if this kind of plays out the way Forrest is saying, this is massively beneficial. So something to definitely keep on your radar, and I'm sure that our chief economist, Steen Jacobsen, would be talking about this to come. And I've not seen it really being discussed too many other kind of places. So moving on, just a few charts. We're going to go through this super kind of fast because we have quite a lot. But again, here just emphasizing again, consecutively big weekly closes on gold, and kind of that 1500 kind of level, so to speak. Amazing to just think how much we've broken away from, these 1350. Where we were just a few weeks back. Ditto on silver. These are all weekly charts, so, above 200, still looking, bullish on the MACD kind of perspective. And as I kind of point out, we're still not above the highs of 2018, right? Whereas when you go back on gold and it's on multi-year highs. This here is the VIX. Big kind of spike up that we saw, touching kind of 25, so to speak. Again, if history is kind of any guide in this kind of cycle, we will see kind of dampened volatility again coming soon. Structurally, as I stated before, if I'm correct that we do continue to make lower yields over time, that should also dampen volatility. So I'd expect us to go back into a world with record low volatility. So even, taking out that kind of 856 kind of figure, which was insane that we touched in kind of 2017. So structurally, I still think we can move back. Doesn't mean that we can't see spikes because, you can even see we had spikes around kind of this period when vol was very low. But I still think it's only moving one way as so long as yields keep on moving down. This here is SPX, MACD, RSI kind of showing to be kind of bearish, so to speak. I'd expect kind of 2800 to just be a key level to kind of watch. This here is the NASDAQ. 7,000, I guess, is key kind of 100 week. I mean, whether it gets there or not is a whole kind of different thing. This here is HSI. Obviously, big kind of pullback with all the issues that Hong Kong has kind of been going through. Hard to see things changing dramatically for the better kind of anytime soon. But again, this is a key kind of support that we are on at, is this 25,000 kind of levels, 25,700, the 200 kind of weekly. It is noticing and interesting to watch. The RSI seems to kind of be flattening. MACD is still expanding kind of out, so I'll definitely be kind of watching this. Or if you think there's support here, obviously just place a stop outside of maybe the lows that we've previously kind of gone into in that kind of candle there. This here is the Chinese 300 index. You can see actually has been holding up pretty well. We are above kind of the 100 week. This here is the Nikkei. Again, key level is this 20,000, so to speak. RSI and MACD, though, are still negative. Again, will be very hard, I think, for this to rally strongly with dollar yen still staying kind of where it kind of is. So we definitely need sentiment, geopolitics to kind of get arguably better. And if we do have some kind of a change towards a weaker structural dollar from whether it's the Fed, whether it's Trump through the Treasury Department, or some kind of other agreement, then it's again really hard to see yen and the Nikkei kind of outperform, which kind of goes back on kind of what one of the preference trades I had was long EM equities versus short Japanese kind of equities. Here we do have the Australian index, a big kind of pullback, negative again on the MACD, negative again on the RSIs. Here again, all this is weekly. This is DXY, as you see, that 98 above that key kind of 97 level that we just could never really kind of crack. And again, we couldn't also break 96 to kind of the low side. That's really the big level to be watching, at least for those of you that want to jump on as bears or that want to kind of maybe get out or exit kind of your US kind of dollars. This is CNH, obviously a big uplift through 7. People shouldn't be too surprised that 7 was broken. Spoke to a few people who've seen, because as we already flagged, the language this year was very different from the language last year. Last year, 7 was very much a line in the sand, and this year it was definitely indicated by several different kind of officials and people from places of influence in China that it wasn't quite necessarily aligned kind of in the sand. I said the timing again for this in regards to us getting below 7 or continuing to climb up is both a combination of if Trump wants to come back and solve this, i.e. in the rundown to kind of the elections, or if he wants to kind of continue to be doubling down and making things kind of worse, because this would just be, in my mind, a tool that you would use to kind of alleviate any kind of tariffs. And of course, as a central bank, you will not go out and say that you're going to weaken your kind of currency, right? So that's kind of quick food for thought here. This is yen, obviously, still bearish in regards to kind of dollar yen lower. This here is Aussie. It looks like it's trying to kind of bottom out, given kind of over the last kind of few weeks, but we can see some pretty long wicks on these candles, so to speak. But it'll be interesting to see whether or not we kind of get a bounce. And interesting to see if this kind of continues to hold up despite a lot of kind of the negative kind of sentiment to come. This here is obviously the Kiwi post 2 weeks ago, the 50 basis point that I think surprised a lot of people. I'm glad we didn't do that Monday, because I definitely would have gotten this one wrong. This one here is Aussie Kiwi. Looking obviously positive for Aussie now that we have RBNZ at also kind of 100 basis points and momentum MACD crossing up, RSI kind of moving up. This one here is the new inversion that we have on the curve. So this is the 2s to the 5s. So we're now at minus 6 basis points, and you can see it's kind of around mid-2014 that we started to get like an indication that the Fed was going to be kind of hiking. So this has been just one big flattening move. We already had 2 cuts, and the curve is not steepening. This here is really the one that everyone's watching. 210s. If you recall, I thought that we were in this 20 to 30 basis point range, and that we'd potentially be breaking up to 50, 75, and 100 once we started to get some cuts. That has definitely not happened. We've just continued to flatten, and I think it's looking potentially even more interesting now from kind of a risk reward perspective, but obviously I could just be missing something, and maybe what this is basically saying is the market is exceptionally worried about a recession and does not think a Fed cutting is going to change that kind of anytime kind of soon. This here is 10-year US rates. Remember I said we're going to be seeing all-time new lows. That's still 136 to kind of be broken kind of through, but it's just been a tremendous move lower. I believe on the 30s we're all-time new lows. This here is Treasury 10-year bond future prices. Breaking out high, but still not yet quite past that peak in 2016. This here is Bunds. This here I think was a macro Monday where we're saying, yield QE for life 1, and then I think we had a QE for life 2. Here we're about 20 basis points. Now we're at minus 70, which is quite astonishing. I mean, and you have to remember this is even pre the September kind of ECB meeting, September 12th, where they will be moving if Draghi has managed to get the political kind of clout for more forms of kind of easing. This here is the 10-year bond for Japan, minus 23 basis points. Interestingly enough, not at the all-time lows in 2016, so maybe that will kind of go lock in step with the U.S. This here is a little bit, maybe looks like a bit of a noisy chart, but let me just explain. So we do have 10-year yields from the likes of the U.S., Europe, and Japan. So the U.S. is obviously